Today, we're going to break down what you could call a perfect storm of economic pressure that the U.S. is putting on India. We're talking about some absolutely massive tariffs, some pretty serious geopolitical penalties, and a huge trade deal that's basically hanging by a thread.
So picture this. The date is October 1st, 2025. And all of a sudden, India is staring down the barrel of a 100% tariff on its key drug exports. It's facing crippling penalties for buying Russian oil, and a trade deal that everyone was counting on has just completely stalled out. Now, these aren't just random, disconnected events. They're all part of an interconnected crisis. So let's get into it and figure out what is really going on here.
All right, first up, let's tackle that huge headline-grabbing tariff. This one is aimed squarely at India's pharmaceutical industry, which, as you know, is an absolute powerhouse.
100%. I mean, that is a staggering number, right? It's designed to grab your attention. The U.S. has slapped this tariff on all of India's branded and patented drug imports. But the real story, the key, is in the fine print. It's not about all drugs. It's about very specific ones.
And this is where the story gets really interesting. You see that scary 100% number? Well, it completely misses the biggest piece of the pie. A massive 85 to 90% of India's pharma exports to the U.S. are generics. And guess what? They're totally exempt. The tariff only goes after that much smaller slice of the market, the patented and branded drugs.
So, in the real world, this policy creates a very sharp divide. It's almost like two different worlds. You've got companies like Piramal Pharma and Zydus who are pretty well insulated. They might even come out ahead because they have manufacturing plants right there on U.S. soil. But then you look at the other side and you've got big names like Sun Pharma and Dr. Reddy's who are facing some serious risks to their profit margins on all those specialty drugs they export from India.
Okay, so let's move on to the second threat, and you'll see how these pieces start to connect. This is where energy security slams right into geopolitics. And yeah, we're talking about India's growing reliance on Russian oil.
Just look at this shift. It is absolutely dramatic. Before 2022, Russian oil was barely a rounding error for India. We're talking just 0.2% of its imports. Now, fast forward to today, and that number has skyrocketed to nearly 40%. Russia is now India's #1 supplier. And why? Well, it's all about deep discounts that have saved India somewhere between $10 to $15 billion, a huge amount of money.
Now, you'd think the U.S. response would be to put a tax on the Russian oil, right? Well, nope. That would be too simple. Instead, they've triggered a 50% penalty. But, and this is the part that so many people miss, it's not a tax on the oil itself. It's a punitive duty on completely separate Indian goods, basically as punishment for buying that oil.
So instead of going after the oil, the penalty is designed to hit the very backbone of India's consumer export economy. We're talking textiles, gems and jewelry, apparel, marine products. But notice what's exempt: pharmaceuticals, electronics, energy. This isn't a random shot in the dark. It's a very calculated move designed to inflict pain on specific vulnerable industries.
And let's be really clear, this is not just some abstract trade dispute between governments. This single policy puts an estimated 400,000 jobs directly at risk in India's huge textile and diamond processing hubs. It takes a geopolitical decision made in Washington and turns it into a real threat to people's livelihoods on the ground in India.
So how is India responding? Well, for its part, India is standing firm. The official position from New Delhi is that this isn't about choosing a side or some political alignment with Russia. They frame it as a defense of their macroeconomic stability, basically a necessary move to protect their 1.4 billion citizens from just crippling global energy inflation.
And all of this brings us to the third piece of this very complicated puzzle, the trade deal, the one that was so highly anticipated and is now, well, pretty much collapsing.
The whole stalemate really boils down to this. On one side, you have the U.S. demanding much greater access for its agricultural and dairy products. They want India to tear down some of its protective tariffs. On the other side, India is coming back with counteroffers saying, hey, we'll buy more of your defense equipment, or we can diversify our oil imports away from Russia to places like Iran or Venezuela, but they just can't seem to find that middle ground.
So what's the bottom line here? It's pretty simple, actually. Any progress on what could be a truly historic trade deal, we're talking one that was aiming to boost bilateral trade to $500 billion, is completely blocked. It is effectively being held hostage by this whole dispute over Russian oil.
Okay, so with all of this geopolitical turmoil swirling around, you have to ask, what does it actually mean for investors, for their portfolios? Let's take a look at how the market reacted.
As you'd probably guess, the market's reaction was swift and it was sharp. Back in late September, the whole pharma index took a pretty big hit. But the stocks that were directly in the crosshairs, Sun Pharma, Dr. Reddy's, they initially plunged by as much as 30%. That was before investors really started to dig in and understand the nuances that we were just talking about.
So for anyone watching their own portfolio, trying to navigate this kind of thing requires a clear strategy. A simple three-step approach is probably a good place to start. First, analyze your own direct exposure to these at-risk companies. Second, go review your mutual funds to see if you're heavily concentrated in affected sectors like textiles. And third, maybe consider using ETFs to hedge against some of this volatility.
And speaking of ETFs, there are a few different ways you could play this. You could go for broad market exposure with something like INDA or EPI, or you could take a more defensive position with an ETF like PIN, which tends to favor those exempt sectors like IT. Or you could even make a long-term bet on India's domestic manufacturing growth with an ETF like GLIN. You have options.
Ultimately, when you zoom all the way out and look at the big picture, what's really going on here is a fundamental shift in what's driving the markets. It seems that, for the foreseeable future anyway, major political decisions and these big geopolitical chess moves have replaced pure economic fundamentals as the primary force steering investments in this part of the world.
And all of this leaves us with a final, really crucial question. As these sudden, politically driven policy shocks become kind of the new normal, it's not just about picking the right stocks anymore. The real challenge for both individual investors and for entire nations is figuring out how to prepare for and how to hedge against the volatility that is absolutely sure to come.